What's up, everybody? Joe Brown here with the Heresy Financial Show, and it is no secret that inflation has taken its toll on American citizens over the last couple of years. In order to combat this, the Federal Reserve, over the last 2 years, has said, nah, doesn't matter, it'll go away on its own. Now, as that's become increasingly apparent that that is absolutely not going to happen to everybody, the pressure has been laid on the Federal Reserve. You've got to do something about this. And so they stopped purchasing assets on their balance sheet. They've started raising interest rates. They're now talking about when they're going to start selling assets off their balance sheet. But there are two who believe that interest rates need to move, number one, much higher, much faster than the Federal Reserve currently has planned. And so we are going to take a look at what that would look like for the Federal Reserve to take that much more aggressive approach in fighting inflation. And can the federal government actually afford it? Can the federal government actually sustain it? Because we've talked about in the past how if interest rates get too high, the federal government is going to default on its debt. So we're going to talk about one way around that, how the Fed might actually be able to increase interest rates at the same time as not allowing the federal government to go bust. Ready? Let's dive in. St. Louis Fed President James Bullard released a statement recently that explained why he was the only one who voted against the 0.25% interest rate hike at the recent Federal Reserve meeting. And he's basically saying we need to go faster and higher than that. He would have preferred a 0.5% move up in interest rates and thinks the Fed needs to get to 3% by the end of the year. Along with that, the former Treasury Secretary Summers said that he thinks the interest rates will need to get to 4 or 5% before they're going to do anything to inflation. The basic reasoning was that if you want to have a neutral monetary policy that is not contributing to inflation or deflation, and we've just had inflation, you've got to raise interest rates by more than the inflation rate. And so he's saying we probably got to get up to 4% just to get even, not to even fight the inflation. Which brings up the question, if that's what it takes, let's say 6 months from now, inflation is still raging at 8, maybe even 9%, and the Federal Reserve is at, let's say, 1%, maybe 1.5%, and they decide to kick it into high gear and raise interest rates to 3%, 4%, maybe even higher, 5% by the end of the year. What will that do to anybody carrying debt? Number one, carrying a lot of debt, and number two, carrying a lot of debt at very low interest rates. The main player here that everybody's going to be concerned about is not the corporations who could go bankrupt. It is the federal government, the United States federal government, the most over-leveraged, over-indebted entity in history. They've got $30 trillion worth of debt, most of it at extremely low interest rates. So what happens if rates move up? Well, number one, it doesn't change the interest rate that the federal government has to pay on any of its existing debt, right? Because it's only changing the new debt. And if they were to roll it over, if they were to take on new debt to pay off old debt that is maturing, then that new debt would have the higher interest rate. But it doesn't do anything to the existing debt that hasn't matured yet. If they've got 1 year, 5-year treasuries, 10-year treasuries, 30-year treasuries. Those are all locked in at a fixed rate that the federal government will have to pay those interest payments and then the principal on maturity. That's locked in. If interest rates were to move up to, let's say, 5%, it would take a couple of years for that to catch up to them before they weren't able to pay their interest payments before. Well, first, interest payments would become the largest expense on their budget, and then it would get to the point where they're not even able to pull in enough in taxes to pay the interest rate. And if you can't pull in enough in taxes, the only way you're getting more money is by borrowing more. So within just couple years, it's like the snake eating its tail. If you're taking on new debt at higher interest rates to pay off that old debt that you already can't afford, it would, the national debt would balloon to 100 trillion, 500 trillion over the course of a very short amount of time, relatively speaking, as it would be having to take on more and more new debt at higher and higher interest rates to pay off the old debt, and that would continue into a downward spiral. Now, that's the classic explanation of why the federal government can't afford higher interest rates. But we are forgetting one big piece of the pie. We are forgetting the Federal Reserve. the Federal Reserve, as they raise interest rates, has the ability to continue quantitative easing, QE, even if they're raising interest rates. They can let interest rates go to 4%, 5%, 6%, let's say even 10%. And then they can buy as much debt as needed in order to avoid any major players going bankrupt, defaulting, not being able to pay that debt. So if the federal government looks at this and says, hey, we've got to pay off $1 trillion worth of debt this year because it's maturing, and it was at a 2% interest rate, we can't afford to do that out of taxes because they're not making that much in taxes, let's say, after they pay for everything else. So they're going to have to take on new debt in order to pay off that old debt. They're going to have to borrow an extra $2 trillion to pay out, or sorry, an extra $1 trillion to pay off that old $1 trillion. But the interest rate is now double. Let's say it's at 4% instead of 2%. Well, when that happens, they can't afford that. But who are they borrowing from at this point? And this is where the Federal Reserve comes in. The Federal Reserve can resume QE even while letting interest rates go up, and they can make non-competitive purchases from the open market of U.S. Treasuries. So if interest rates are 4%, they can buy enough Treasuries at 4% in order to make sure that any debt that the government borrows gets through to them from the Federal Reserve. That way the Federal Reserve's balance sheet, let's say, goes from 8 trillion to 9 trillion or from 9 trillion to 10 trillion. All the new debt that the federal government borrows basically comes directly from the Federal Reserve, even though it goes through the banking system first. Why would this help? Well, because the Federal Reserve doesn't keep its profits. The Federal Reserve is a quasi-public, quasi-private entity, and after they pay for their expenses, which compared to their revenue, very, very small, all profits are swept back to the Treasury. This means that any federal government debt held at the Federal Reserve is essentially interest-free debt to the federal government. This means that if the Federal Reserve were to own 100% of the national debt would be essentially free to the federal government. They wouldn't have to pay any interest because any interest they pay comes right back to them from the Federal Reserve. So if you pair rising interest rates with QE, you can essentially squeeze the private market, squeeze the debt markets to try and attack inflation, try and get spending down, try and decrease the total money supply in circulation, while at the same time not risk your federal government, your central government, defaulting on its debt by just absorbing it all. This is pure debt monetization. Debt monetization is basically just a fancy word for inflationary financing. It means the national debt at that point becomes just something on paper. It's not real debt. It's just something that exists as a relic of a bygone era. And essentially what's happening now is instead of funding the federal government spending through taxes and borrowing, really the federal government is financed through taxes and printing. And that's it. It goes through a bunch of loopholes and steps and jumps over fences on the way to get to that point. But essentially the end result is, yes, the federal government will get some money from taxes that they'll be spending in different ways. The rest of their money, even though it looks like borrowing, is not borrowing. It's directly financed by these central banks printing. Even though it looks like debt, it's not. Even though it looks like they're paying 5%, 6%, 7%, heck, the interest rate could be 100%. Doesn't matter. It all gets swept back to them. It means it's basically interest free. Now, the other thing that they could do if things get bad enough, they could do this same trick for anybody. They could do this for banks. They could buy any debt needed, any corporate debt. They've already bought high yield bonds through ETFs. They've already bought investment grade bonds through ETFs. They could do this to make sure that nobody goes bankrupt or defaults on their debt, even while interest rates are rising, because they could own the debt. Now, it's a little bit more tricky with the corporate debt because there's no mechanism built in already to sweep the profits back to those companies from the interest rates. So the companies would still have to pay the higher interest rates, but then you could enter in another trick where instead of just buying debt, the Federal Reserve is also able to buy equities. And then the governments, not the governments, the corporations can finance their debt expenses through the issuance of new shares and diluting the equity, since it's not investors that would have to take the hit on that. It's the Federal Reserve who's buying that. So in a roundabout way, with one little change, the Federal Reserve could do the same thing to corporations to prevent large corporations and financial institutions from going bust, even in a situation where interest rates are skyrocketing, where you give the large corporations, the financial institutions, and the governments a way out of not having to pay that higher interest rate while everybody else does. Because let's be honest, you and I are not going to get a kickback from the Federal Reserve if we can't make our credit card payments, our car loan payments, or our mortgage payments. It's not going to happen. If things get bad enough, it might, but at least at the beginning, until everybody's squeezed hard, it wouldn't be happening. So that is what's going on right now, and that's kind of the loophole that's snuck into the back pocket of the Federal Reserve right now, where they know that if they need to raise interest rates high enough, they've got one last trick that they can pull out: start QE back up again while the interest rates are going up to prevent the government from going bankrupt, and then they can slip in equities purchases, stocks purchases, in order to finance the equity dilution, the issuance of new shares by corporations to finance those rising interest rates so that they don't have to really pay for it out of pocket themselves. I hope that makes sense. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.